Hello, everyone. Welcome to this month's live Toronto real estate market update. For those of you who are new to my updates, welcome. My name is John Pasalis. I'm the president and broker of record here at Realosophy Realty in Toronto. I like hosting these, live updates on what is happening in Toronto's housing market because I really believe that consumers with access to the right information and right advice make better real estate decisions. And that's very important because our real estate decisions have an outsized impact on our finances and our quality of life. If you're considering buying, selling, or investing in the GTA, you can click the link in our show notes to set up a meeting with me and one of my agents. And now on to today's update. So we're going to kind of kick things off today, as always, with a bit of an overview of what we're going to look at. I'm going to kind of give a quick market update on what is happening in the market for houses, what's happening in the market for condominiums. And I'm going to have a little quick chat on unpacking how house prices decline. I mean, I think many of us are often concerned about, picking up the trends of potential future declines in prices. I did a video recently on whether we should see a bubble-like collapse in Toronto, and I kind of want to unpack some of these trends. Unfortunately, our regular guests, Davin McMahon, Gus Papayoannou, both agents in my office, could not join us today. They're super busy running around selling houses, so couldn't join today. But as always, we have mortgage broker David Larock, who's also going to be joining today's discussion to kind of walk us through some of the latest trends in the mortgage market, in the economy, and what to look for when we're thinking about potential future rate cuts. So let's just jump right into it by starting off with a quick look at what is happening in the market for low-rise houses. So I'm going to kind of start off by kind of chatting about the market for detached homes in the Toronto area. Sales were about 2,500 in the month of February, and that is up about 21% over last February. But if we look at some historical data, we're below sort of the 10-year average. We typically would see around 3,100. And the sales volumes do fluctuate a little bit. We had these periods in 2017 and 2021 where the market was crazy and sales were quite high. And then when the market declined, similar to last year, where sales kind of were a lot softer, we're obviously below that. So we do see some volatility, but we're still kind of well below I'd say the 10-year average in terms of sales volumes for the month of February. Now, when we look at new listings for detached homes were just about 4,800, 4,850, up 32% over last year. And I've talked about this on previous shows and episodes. The one big thing or big difference between last year's market, the reason partly why we saw prices accelerate was not just because interest rates sort of softened up in the first half of 2023 because of the decline or collapse of Silicon Valley Bank and other indicators, but also because new listings were at a 20-year low. If we were to look at sort of the new listings for 2023, they're actually for last year in February, they're actually a historic low. Like even going back to 1997, we hadn't seen new listings volumes that low for the month of February. And that was really one of the big drivers between the slight uptick in prices we saw at the beginning of 2023. So new listings are rebounding just under 5,000. That's about a bit below the 10-year average, typically see about 5,400. But again, a positive trend for buyers to see a little bit more stability in the market. And then when we look at active listings, well, they're quite soft. I mean, we're down a little bit from last year, down 5%, interestingly enough, in terms of the number of active listings in the market, just about 3,900, and below the 10-year average. And again, active listings is a function of sort of demand and sort of the sales and the new listings. So that's why sometimes we can see divergent trends, because new listings can be high, but if sales is quite strong, that can absorb some of the new listings hitting the market. Now, when we look at the months of inventory, and we're going to pause here to unpack why this metric matters. So, I mean, for those of you who are new, the month up to the segments, the months of inventory is basically just the number of active listings at the end of the month divided by the number of sales for that month. So if there were 10 active listings at the end of the month and 5 homes sold, in that month we would have 2 months of inventory. If only 1 home sold, we would have 10 months of inventory. So the lower the months of inventory, the hotter the market, the tighter, the more competitive it is. And the higher the inventory levels, the cooler it is. There are more homes to choose from. Now, when housing markets typically cool down, I mean, they typically cool down in one of two ways. I mean, in sort of the US market, when the bubble collapsed, it was quite different from how Toronto's market collapses. And I think it's important to understand this. In the US, it was a far slower process. You know, what happened was, and this is, again, looking back to 2006, sales declined, sentiment shifted, it became negative. Sellers were kind of sticky on their prices. So prices actually didn't fall right away. And what happened is inventory builds up. And sometimes in some markets, you would see inventory go from 3 months of inventory, 4 to 5 to 10 to 12, like a year's worth of listings. You know, and this is a very soft market. And then eventually, as inventory kind of hits this very elevated level, you know, some sellers just break and end up selling, and prices start declining. And once kind of that momentum has shifted, you know, obviously the sentiment shifts to negative, and you know, one seller starts selling less than the other, trying to avoid future declines. And that's how it happens sort of in the US. That is, I'd say, a little bit more typical. Toronto's housing market is not as typical as that. The declines in prices and the shifts are far more rapid. And we're going to try to unpack that a little bit by looking at some of the volatility that we've seen in months of inventory and prices. So if we look back to 2015, you know, months of inventory at the beginning of the year was about 2 months, and it kind of hit this downward trend. I mean, it went up and down a little bit, but by early 2017, we had less than a month of inventory. And that was a period when home prices were accelerating rapidly. And then what happened in 2017 is the provincial government put in a foreign buyers tax and a few other new policies. But really what that did is it really shifted the sentiment in the market. And we went from a market that's super heated and super bubbly to one where inventory, or months of inventory, I should say, just skyrocketed from under 1 month of inventory to just under 4 months of inventory. And what happened in this period? Basically, buyers kind of pulled out of the market because they were worried that things were going to cool. Sellers rushed into market thinking that it was the peak, and we had this rapid change. Now, and this is actually in Toronto. What makes Toronto different is it was in this very tight period. That's like that acceleration happened over maybe about 4 months, where prices fell dramatically, and prices didn't stick the way they did, say, in the US, in part because of the dynamics in the GTA's housing market. And what I mean by that is, in the Toronto area, most people who are upsizing, for example, or downsizing, will typically buy a home first and then sell their existing home. And that's typically because it's a lot harder to buy than it is to sell. Homes usually sell pretty quickly. The challenge with that is if you get caught doing that in a market that is shifting, you find yourself needing to sell in a market where demand has almost disappeared. And that's what happened in 2017. I'm going to talk about what happened as well in 2022, but that's really what happens. And you end up effectively being a distressed seller, because in most of those situations, the homeowner needs to sell their existing home in order to close on the home that they just purchased, which means even if they're getting a price that's 50 or 60 or 70,000 less than what they're expecting, they can't just hold on and wait. They kind of have to take that price that is less than what they're planning for. And that's really what happened in 2017. And then we have this, you know, period between, I'd say, late 2017 to early 2019, where inventory levels bounced around somewhere from, you know, 3 to 3.5, and prices were actually quite stable. Nothing really fell. I mean, it was kind of a boring market. Prices were relatively flat, not a lot of growth, and things were relatively sluggish. On some of the previous charts, you would have seen a ton of inventory, active listings for that month, and that's sort of the period we're looking at. And then at the beginning of 2019, the market just accelerated. And we kind of see months of inventory went from just under 4 months again to like half a month at the beginning of January 2022. And we had this spike in early 2020. That was the lockdowns. So that kind of sort of shifted the momentum of the market temporarily when sentiment was negative, when people were we were in the beginning stages of this lockdown. And that's why we see this one sort of outlying blip. But for the most part, months of inventory went from 3.5 to half a month of inventory. It's a super competitive market. And again, it bottomed at the beginning of 2022. And then similar to 2017, oh, I stopped sharing. Let me share my screen again. Similar to 2017, we had this rapid shift in sentiment again. And again, a lot of this was driven by the fact that rates started increasing. And then we saw this rapid increase in months of inventory from half a month of inventory to about 3 months of inventory. And even though that's not a ton of listings or a ton of inventory, the sudden change in sentiment, the sudden pullback in buyer demand was enough again to cause prices to decline. And that's what we saw basically in 2022. Prices fell. And since then, I'd say for the most part, prices have been relatively flat. We did see a little bit of a run up last year, a little bit of a pullback in the second half of this year. But where we're at now is a market right now where inventory is technically declining. And this is, again, an indicator of a market that is heating up. Now, I'll say, and we'll talk about it at the very end, I'll look at sort of the latest weekly data, but it looks like the market is kind of not so much accelerating, but taking a foot off the gas. If we look at sort of weekly trends, it looks like new listings are kind of matching supply and things are balancing out. So the one takeaway from here is that we want to keep an eye on, at least in the GTA, potentially these sudden shifts in buyer sentiment, seller sentiment, floods of listings. This is usually what causes these sudden changes. And as someone who might be buying and selling and upsizing, we have to be very mindful of these shifts, because you don't want to be the person who gets caught out buying a home and then selling if we end up seeing another kind of shift in the market in the future and things slow down. And, when we had clients in all of these periods, I mean, we kind of cautioned them because we could see on the ground when the market is shifting. I mean, we couldn't predict, obviously, the change in prices and how quickly things would evolve. But the earliest indicators we kind of see on the ground when people start pulling back and the sentiment starts shifting. So that's a little bit about how to kind of keep an eye on sort of the momentum in the market and how prices might change in the future. But right now, we're not in a cooling market. We're in a market where sales is effectively outpacing listings, but I think that might be plateauing. Now, going to look at the prices for low-rise homes, they hit 1.36 for the month of February, up over last month, unchanged over last year. So we're basically where we started last year. So we saw a bit of an increase in the beginning of the first half of 2023 last year. In the spring, prices dipped a little bit in the second half because rates increased, and now we're kind of back to where we were. So one thing to keep in mind is if prices stay stable over the next 2-3 months, we're going to actually see prices actually be down year over year, specifically because of these reasons. So let me move forward. Because we're going to be comparing to sort of these peaker prices when prices accelerated in March or April, hitting just under 1.5. So that's one thing to keep in mind. We might see that even if prices kind of stay at this current level, we'll probably be down year over year shortly. Going to the condo market, condo sales are about 1,600. They're up a little bit, 9% over last year. The 10-year average is about 2,000. Again, we see these ups and downs in terms of sales. So we're, a little bit below the 10-year average. I'd say quite a bit below the 10-year average for sales. When we look at new listings were up 35% over last year, just about 3,800 new condo listings, and that's well above the 10-year average. Typically, we see about 3,000 listings, 3,800. And similarly, when we look at active listings, we're well above where we typically are for the month of February. I mean, February, we had about 5,100 listings or 5,200 active condo listings, up 34% over last year. The last time we've been at this level was back in 2015, 2014. Between now and then, inventory levels or active listing levels have been quite low. So we're well above sort of recent trends, but we're in line with the levels before 2014 and 2015. Similarly, months of inventory for condos has been trending down. We're about 3 months of inventory for condominiums. Again, it peaked over 5 months, 5.5 months in the fall, but that has been trending down. And much like the market for low-rise houses, prices hit 726 and they're basically unchanged over last year. When we look at, and I'm just going to wrap up the stats before we bring David on. When we look at, I mentioned sort of months of inventory. If we look at a sort of a higher frequency time series and look at this on a weekly basis and see how this is evolving, we can kind of see months of inventory right up until basically this week for houses and for condominiums. For houses, we hit basically about 2 months of inventory. Condominiums is about 3 months of inventory. And the important trend here is we see things like the momentum is starting to ease off. They're starting to hit a bit of a plateau. It's not like inventory levels continue to plummet down. And this is kind of when we see them continuing to rapidly accelerate down, it's like the market is hitting the gas. When we see them plateau, it's like it's taking the foot off the gas. And of course, the flip side is when we see inventories kind of start to trend up, it's like we're hitting the brakes on the market. So it looks like we're starting to take the foot off the gas, certainly for condos and even for low-rise homes. It looks like inventory in the months ahead, what this relationship between sort of new listings and sales looks like, that's ultimately what's going to drive the balance between the two. So I don't know if we have any questions about that, and if we don't, maybe we'll just bring David on if he's here with us. Mr. Larock.
As Dave comes in, we're getting some questions, John, for mortgages. So we'll just hold those to the end of your chat with Dave.
All right. Welcome, David. As always, everyone, we have David Larock joining us. David is a brilliant mortgage broker. He writes for our blog every week on Move Smartly with always the latest takes on economic trends, Bank of Canada's announcements. So, Dave, why don't we kick off and get some of your latest thoughts from your latest posts and sort of the pause from the Bank of Canada and what your thoughts were following that.
Well, I mean, like everybody, I expected the Bank of Canada to hold, and so that wasn't a surprise. But what did surprise me was that the bank maintained a fairly hawkish stance about rates. Now, there's lots of theories about why that is. For one, if they say that we think we might have to cut soon, that could cause the market to react by lowering bond yields and create a form of stimulus in the market that would then undermine its attempt to continue to slow demand and slow inflation. But there are increasing signs that the economy is weakening and weakening pretty quickly. Our GDP was we since the last BOC meeting, we learned that our GDP came in at 1% in the fourth quarter, but John, we hear this all the time. That was because of record immigration. When you look at GDP per capita, it fell again, and it's fallen in 5 out of the last 6 quarters. So our economy is technically growing on a headline basis. Overall, it's getting bigger, but the average Canadian sees less economic output associated with them, and that's why people feel like we're in a recession, even though the data says, and a recession, of course, would be two consecutive quarters of negative GDP growth, at least the most common definition of recession. And even though the GDP numbers are slightly positive, it certainly feels to a lot of Canadians like we're in a recession for that reason, because but for record immigration, our economy is slowing. Same with jobs. We've created about 350,000 new jobs over the past year. That sounds pretty impressive. That would be a decent year for job growth, but we've also brought in more than 1 million new immigrants. So when you apply the lens over top of that of are we adding or subtracting relative to our labor force? No, we're adding capacity. Now that's good news for the Bank of Canada. They want wages to come down and they want to increase the supply of labor. But again, to the average Canadian, it doesn't feel like the jobs market is chugging along much anymore. The criticism a lot of people are making of the Bank of Canada lately, and again, this for some of us would have been their opportunity to acknowledge it, is most of the inflation we're getting now is related to shelter costs, and specifically within shelter costs, mortgage rates. And mortgage rates have gone up 27% year over year. And of course, that is directly a result of Bank of Canada monetary policy. If the Bank of Canada wants to slow the type of inflation associated with mortgage rates, it needs to cut its policy rate. And if it does that, it's going to solve the problem. If we back out the increase in mortgage rates over the past 12 months, we're at 2% right now. Inflation is back to target. And if we don't include all the shelter costs, we're down to 1.5% year over year inflation growth. Now, I don't love when people cherry pick, and I don't want to sound like we need to dismiss those things out of hand. Mm-hmm. One of the arguments the bank would make is say, well, if interest rates weren't high, we'd have other kinds of inflation. So pick your poison. If you don't have mortgage inflation, then you're going to have other kinds of inflation. And the reason rates need to be high is because we still need to cool demand in the economy. But the bank is supposed to skate where the puck is going, not react just to lagging indicators. And a lot of the forward indicators show that businesses and consumers are becoming more pessimistic. Job vacancies are declining. Quit rates, which is a sign of employee confidence, the number of Canadians who are quitting their jobs to leave for greener pastures, those rates are declining. Wages are now falling. They're still pretty high. We're growing year over year by about 4.9 now, but we were at about 5.1. Insolvencies are going up. Business bankruptcies have skyrocketed of late. There's some theory that maybe that's because some businesses were sort of kept alive or even formed to take advantage of some of the COVID benefits that went to businesses. Mm-hmm. So there might be some noise in those numbers, but they've spiked to a level where clearly there is a deterioration. Credit card utilization rates are going through the roof. People need to borrow now to pay their bills. Credit card defaults are rising. Mortgage defaults are rising. You see some crazy headlines saying mortgage defaults up by 125%. Well, that's true, but they're off a very, very low number, and they're not even back to their historical long-term averages. So shame on the people who in those cases are saying mortgage defaults are up 125%. Well, if they've gone to 19 basis points, which is still below the long-term historical average. Yeah. But the reality is there are early signs the economy is deteriorating. And if the Bank of Canada is going to skate where the puck is going, really the thing it has to reconcile, and it didn't really address this during the press conference, it has to reconcile the fact that right now, the shelter cost problem is a supply-demand imbalance that is a structural problem that is due to the policies of our federal government. I love immigration, but we have too much of it based on relative to our housing supply. And the second problem we've got is right now, mortgage costs account for 19% of the average Canadian's discretionary income. That's a record high. But only about half of Canadians thus far have had to actually renew into higher rates. We've still got a lot of Canadians sitting on those low rates. And in fact, for the half that haven't yet renewed, a lot of those guys got pandemic rates, ultra low pandemic mortgage rates of below 2%. And if you think the percentage of discretionary income being put towards mortgage interest costs is high now, just wait till the other half of Canadians renew. Because right now, people are renewing 3.5% rates into 5% rates. The next half are going to be renewing rates 2% or lower, or a lot of them are going to be 2% or lower into 5% rates. So that strain on discretionary incomes is going to be magnified as the next half of Canadian mortgage borrowers have to renew. So if you're the Bank of Canada, you see signs of slowing already. The only reason inflation isn't back to target is because of the mortgage interest costs, which you directly control. And you know that the next half of the Canadians who have to renew are already going to face substantial increases, more substantial increases than the Canadians who've had to renew thus far. I guess you'd say, how much more do you need to see? I mean, if all you do is keep rates the same, or even if they fall by 0.5% or 1%, Canadians renewing their mortgages are still going to be heavily impacted, and all of that is already preloaded into the pipeline. So I was among the group that thought that the Bank of Canada would tilt a little bit more dovish in its last statement. They're holding firm. And a lot of us now are increasingly concerned the economy is going to slow by more than expected. I think the soft landing fantasy is just that. I don't think we're getting a soft landing. I think we are going to get a hard landing for the economy. And ultimately, the Bank of Canada is, I think, rightly taking some criticism for its insistence on holding fast when the data suggests that if it skates where the puck is going, maybe it shouldn't be long before it starts cutting.
Wow. Thank you, David. You touched on a lot that I want to try to unpack and maybe ask you a few questions. So you talked a little bit about the upcoming mortgage renewals, and in particular, the fact that sort of this next phase are going to see a much bigger increase. People who've been seeing the payment increase over the past year or so kind of had higher rates to begin with. They didn't have these ultra low COVID rates. So you touched on how you think that is going to have a negative impact on consumption, because people are going to have to dedicate more of their mortgage payments to, more of their income to debt payment effectively. And it sounds like this will potentially further fuel inflation. I mean, if more households, does that sound correct?
Yeah.
Like more households now are spending more money on their interest payments on their mortgages, this will further fuel kind of inflation levels. Is that kind of roughly in line with what you're suggesting?
Yes, if rates stay at their current levels, then the 27% annual year-over-year increase is probably going to increase. It almost certainly will. And the problems that we have with inflation right now, being shelter costs and specifically mortgage interest costs, aren't going away anytime soon, unless the Bank of Canada drops its policy rate, and then boom, presto, problem solved. So a lot of people would say, well, if you could solve the problem, and by the way, most of the developing countries that we compare our inflation data to don't include mortgage interest costs in their CPI equivalent calculations for that reason, because it's like a dog chasing its tail. If you have to raise rates to cool inflation, and the very act of raising those rates exacerbates inflation, then really what is the value of tracking that number? Because it becomes a bit of a self-fulfilling prophecy, as is the case here.
Yeah, that's interesting. Yeah, the US uses like a rental equivalence approach, which doesn't really
Owner's equivalent rent, yeah.
Yeah, exactly, which is super interesting, and that's a very good point. So one thing I was going to ask you, so your idea that, or your argument that the soft landing is not going to happen, we're going to hit a harder landing, is that mainly driven by your thoughts on consumer spending basically kind of falling off a cliff? And the impact that's going to have on businesses? Is that kind of the key thing is that the main driver, I think, of why you think we're not going to hit a soft landing?
Essentially, yes. If we look at the rest of the CPI data, the reality is if shelter costs don't change, if mortgage interest costs keep rising by about 27%, and shelter costs overall keep rising by about 7.5%, there's no reason to think those numbers are likely to change anytime soon. The rest of the inflation basket, the CPI basket, has to be at zero. And to get the rest of the CPI basket down to zero, we have to keep hammering demand. And when we hammer demand, that eventually feeds into wage costs. It feeds into the performance of businesses. We've already got record levels of business bankruptcies, so that's going to get worse. And ultimately, that's when you listen to the Bank of Canada, if they can change their mind next week, but if you project forward what they're saying they're going to do, they're going to hold off. They want inflation to actually hit target before they make a move, and they're prepared to wait it out. Then that means there's a lot more pain coming, and ultimately that's not good news for Canadians. But as I said in my most recent blog post, I have written for some time that the longer the Bank of Canada holds its policy rate at these levels, I think the greater the chance that when they cut, they really have to start cutting. And if that's the case, that means variable rates, when they do start to fall, will likely fall by more than they would have if the Bank of Canada had taken a more gradual approach. Now, what does that mean? What does that level look like? I tried to give people an idea in my most recent post. Right now, the BOC's policy rate's at about 5%. And by the BOC's own estimate, its policy rate, it's a neutral policy rate, which is a policy rate where they're not tightening, they're not restricting demand, and they're not restricting economic growth, but they're not stimulating growth. That neutral position for their policy rate is, they estimate, in the 2.5% to 3% range. So to get back to neutral from here, the Bank of Canada needs to cut by roughly 2.5%. But if the Bank of Canada waits too long and they over tighten and the economy goes into a deep recession, then it isn't going to be neutral. The bank's not going to stop when it gets to neutral. It's going to go below neutral. And that's when rate cuts of 3% or more are on the table. Now, that might sound crazy at this point because we don't see the economy looking like it might unfortunately start looking in 6 to 12 months. But if we get there, then it isn't going to, we're not going to see gradual cuts, and we're not stopping at neutral. We're going to need a stimulated policy rate to make up for the fact that the bank over tightened, which it tends to do in when it faces the kind of economic backdrop that it did when it increased as sharply as it did. The other thing to remember, John, we've just experienced the sharpest series of rate hikes in modern history in Canada. And people say, I hear this a lot, well, rates aren't actually historically that high relative to where they've been in the past. And, you know, it's not, that is a true statement, but it's missing a very key piece of information. Mortgages are way bigger than they were the last time rates were at 5%. When the pandemic hit and rates went below 2%, people loaded up on cheap debt. The cost of that debt is now going up by 2 or 3 times. And yes, everybody was stress tested, and that will help us from a mortgage default perspective. But from an affordability perspective, from a discretionary income perspective, from an impact on overall demand perspective, it's going to be like nothing we've seen before. And I don't want to sound like I'm wearing a tinfoil hat. I'm not a Pollyanna. I don't think the housing markets are all going to crash and we're all going to be guarding our vegetable patches with rifles. But I do think that this soft landing idea is fantasy.
Interesting. So I'm trying to, you mentioned a few things. I'm trying to think about sort of the next. So with respect to the interest renewals, let's kind of touch on that again and maybe unpack that a little bit. Do you not expect banks to sort of work with households to soften that, whether that's extending AMs, and they probably will, but I guess are you just kind of suggest that even if they do those things, we're still going to see a massive payment shock, even if banks extend their amortizations and do what they can to soften that payment shock, we're still going to see a big increase?
Yeah, there's only so much the banks can do. I mean, in reality, they did a lot when they allowed variable rate borrowers to not, with fixed payments, to not have to adjust their payments. They can re-extend amortizations back up to original amortization levels. They can help a little bit here and there. But at the end of the day, John, if the bank isn't worried that you're going to default on your mortgage, you know, they don't really care if you buy Xboxes and you upgrade your car. And ultimately, when you look at the economy from an overall demand perspective, Canadians pay their mortgages even when times get tough. We're sort of known for that. And at the end of the day, if it doesn't mean that the performance of mortgage portfolios is being impacted, then there can be enough pain to cause the economy to slow sharply without it requiring banks to offer all kinds of concessions. And quite frankly, I don't think they'll be in a hurry to do that. I'm not sure the regulator would allow it. And at the end of the day, there's not a whole lot they can do. Yes, they can help, but it's not going to be a game changer.
Okay, so then how does that say, I mean, what are your thoughts on how that impacts the housing market? I mean, I think some people are expecting these, and I don't agree with this theory, but I think they're expecting these rate increases to lead to this massive flood of listings and sort of this collapse in prices, I guess is what I think some people are worried about, or some people are hoping for. I mean, I think we'll probably see more listings, quite frankly. I think this is why I like over the past while, I wasn't bullish or I didn't feel like even rates falling to the fours is a bullish narrative, because to me, I think we're going to see way more listings, in part because of higher rates, people just wanting to unload. But how do you see this sort of playing out in the housing market with the people that you speak with? Do you think we'll see some people just unloading properties because of these payment shocks?
Well, I think the market will be tested, John. I think we'll see, for example, you and I have talked about this before, people who own multiple properties and are living off the rental income for those properties. I think that is a less viable business model than it's been. People who made deposits on new construction condos who can't qualify to close now, a lot of assumption sales. I think we'll definitely see more weakness in the market. I don't buy the crash scenarios. I just don't. I mean, look, I'm biased. I work in the industry. My biggest asset on my personal balance sheet is my house. So bias is, fully disclosed. I just don't see it. I think there are two significant floors under house prices, certainly in the GTA. Number one is we still have way too much demand and not enough supply, and that isn't a problem that's going to be fixed overnight. In fact, the level of new construction is falling now because rates are high and builders aren't building as many houses. So I think when the market does heat up again, the supply-demand imbalance is going to be even more exacerbated, because if you look at new construction relative to historical averages, this is more your expertise than mine, that indicates to me that we're, again, supply is not keeping pace. So number one is immigration. The other is cost to build. I mean, if you want to get a raw piece of land to build a house today, I've just done a bunch of renos in the last year, and it's crazy. I mean, every trade wants 10,000 or 20,000. It's one or it's the other. And if you can't build a house or change a house much less expensively, then why would prices fall? Because relative to replacement cost, they're where they need to be. So ultimately, I don't see a crash scenario. Now, do I see a weakening in prices or a change in the market where it's a much more balanced market, as we've already started to see? Absolutely, I think that's possible. People say, for example, well, when rates drop, the housing market's going to get hot again. But if rates drop because we've had a massive slowdown in the economy and we're in a deep recession, I'm sorry, the housing market is not going to catch fire. So I think that's a fantasy. The other arguments people make are, well, and by the way, even if that's true, let's say someone says, I'm going to wait to buy a house until rates drop. And you say to yourself, great, well, you and everyone else I talk to has the same plan. So if that happens and rates drop, you and everybody else are going to go out and try to buy a house. And guess what? There's too many of you and not enough houses. There's an argument today, and maybe it's controversial, but I think it's got some merit. You date your rate, your mortgage rate, and you marry your house. Right now in Toronto, you can negotiate with sellers one-on-one. You don't have to show up on an offer night and try to compete with a whole bunch of other buyers, some of whom will be buying based on emotion and, quite frankly, incompetent from a buying perspective. You don't have to try to outbid those guys right now. And generally speaking, balanced markets in Toronto over the past 10 or 15 years haven't lasted very long. So if you're willing to stomach an expensive mortgage rate for, say, a 3-year term right now, but you can get into the market at a time when you can negotiate directly with the seller, you can include a financing condition, and you're not competing on an offer night where you have to get in a bidding war, there's an argument to be made that if you're going to own the house for 10, 15, 20 years, now's not a bad time to get into the market, because that rate in 3 years, if rates are lower, that rate will reset, and the price you're paying is a one-shot deal. So, date the rate, marry the house. That would be an argument that maybe now's not a bad time to buy. To be clear, John, there's lots of risk in the market. I'm not saying, buy now or be priced out forever. Yeah. I'm not suggesting there aren't risks that have to be weighed, but I think it's a fair point that in my experience, as 15 years as a mortgage broker, it is a lot easier to go and try to buy a house today. Forget about cost. The actual act of buying is much less competitive than it's been for a long time. And who knows how long that will continue.
Yeah, it is. Even though it is competitive, it's certainly less competitive than it has been. And I agree with you. I mean, and just to clarify, I mean, of course, price declines are possible if things, I think what we're talking about is like this massive collapse that I don't think either of us are expecting. But again, obviously these dips are possible depending on where things go. Now, before we kind of jump into the questions, we'll wrap up with one last one. And your thoughts on sort of the latest US inflation numbers and kind of what that means and how that might impact Canada.
Okay, so we just got the latest US inflation data this week, and it showed that inflation came in at 3.2 instead of 3.1. That was about where people thought it would come in, although it was an uptick. So that certainly has the bond market's attention, and yields are a bit higher right now. Of more concern is the fact that inflation increased month over month by 0.4%. So if you annualize that, that works out to a 4.8% inflation rate. That is a bit concerning. There's always a bit of debate about the data. There's a lot of the data is generated through formulas and inputs that aren't actually real inputs. And there's debate, for example, that some of the assumptions around pay raises that typically happen in January are skewing the data. Weather conditions can affect the data. Certainly in Canada, we've had a very warm winter. I think that contributed to our stronger GDP numbers. The market right now is still pricing in the first Fed rate cut in June. The market wasn't moved enough to change that bet. But certainly in the US, John, they've had more growth. They've had a much stronger economy. They've burnt through more of their pandemic savings. The US federal government has a much larger deficit, and they're spending their stimulus spending a lot more than the Canadian government. So part of the strength in the US economy is a bigger savings drawdown and more stimulative spending by the federal government. That needs to be factored in. More inflation in the US will eventually be imported into Canada and would make it more difficult for the Bank of Canada to start cutting. But interestingly, the Canadian dollar hasn't moved much in the last 48 hours since we got the US inflation data. So the market it's not a game changer by any stretch. It's a little bit hotter than expected. It certainly bolsters the idea that rate cuts might not materialize as quickly as people think they should or think they will. But so far, it's not moving the needle more than a little bit at this point.
That's helpful. Urmi, if you're still with us, we'll kind of maybe jump in and take a look at some of the questions we got.
Yes, actually, you and Dave kind of touched on a lot of them, but I will maybe go over some of them. Actually, Dave, I had a question for you. You mentioned to John that the likelihood of banks providing those longer amortizations and accommodating hikes in payments is not likely to continue. And in fact, in late February, I saw a couple of headlines saying that the Bank of Montreal is starting to cut its exposure to those longer amortizations, and that regulators are also encouraging banks to do that. Can you speak a little bit more about that?
Sure. Well, the whole mess so the big issue, the big concern the regulators had is there's two types of variable rate mortgages. There's adjustable variable rates. Well, they're called adjustable rate mortgages. They're both variable rates, adjustable and variable in my industry. Adjustable rate variables go up and down. The payments change every time the rates change. And those mortgages are amortizing exactly as a fixed rate mortgage would, because you're increasing your payments every time the Bank of Canada increases its rate. So the rate at which you're paying off your mortgage principal doesn't change. The only thing that changes is you pay more interest. That's about a third of the variable rate mortgages outstanding in Canada. 2/3 of the Canadian mortgages outstanding are fixed payment variable rate mortgages. So when the rates increase, you pay the same amount, but more of your payment goes towards interest and less goes towards principal. And because we had the sharpest series of rate hikes in modern Canadian history, we reached a point where the minimum payments were no longer covering even the cost of interest. And the banks at that point were, not all of them, but some of them were giving borrowers the option of holding their payment where it is and allowing their mortgage to increase. If you're a bank and someone's got 50% equity in the property and there's a $300 shortfall each month, you can demand the $300 and force the mortgage into default, or you can add the $300 for the mortgage. You've still got tons of equity in the property. It's going to take them longer to pay back the mortgage. On balance, it's more profitable. When the rate at which the mortgage is being repaid slows, then the amount of time it takes to pay it back, assuming you renew that client, it's actually more profitable for the bank in the long run. And because we were going through tough economic times, the regulator said, until these borrowers get to renewal, we will allow you flexibility to manage that. Now, the flexibility didn't last forever. Rates went higher. Eventually, those borrowers started getting calls, and they did have to reset their rates. And a lot of them have done that now, but a lot of them haven't reset back to the original amortization levels. So we get these headlines now negative amortization mortgages and 100-year amortizations. And of course, they take the most extreme examples, but none of that carries over at renewal. When you get to renewal, your mortgage payment is reset. It's based on where rates are at the time. And even if you end up back in a variable rate mortgage with a fixed payment, it's based on today's variable rate levels. And the likelihood that they increase measurably from here is pretty low. And the regulator has now forced the lenders who have fixed payment variables to allocate more capital to that product. And it's effectively made the product more expensive for banks. And it's probably going the way of the dodo. So the reality is, when somebody's up for renewal, they have to reset based on current rates. They were qualified at the stress test years ago. For fixed rate borrowers, those borrowers have paid off principal, and for adjustable rate variable borrowers, they've paid off principal over the full term of their mortgage. So even though rates are higher, they're renewing at a lower balance. For most people, 5 years later, which is the average term, 5-year terms, they probably have higher incomes now and are better able to absorb. I don't personally find, when I'm helping my clients, that, quite frankly, guys, the reaction I get most of the time is relief. They read the headlines and they think their payments are going to triple. And when they find out that they're going up by 40 or 50%, they're actually relieved. Now, you can also extend amortizations. There is some flexibility within the rules you can offer, Urmi. So, for example, a lender can say, we started you out with a 30-year amortization. You had a 5-year term. You're up for renewal now. If we do a straight renewal, then the maximum you can amortize the new loan for is 25 years. You started at 30, you had a 5-year term, 30 minus 5 is 25. Maybe the banks would say, we'll let you re-extend the amortization back up to 30 years to lower the payment. And effectively, that means you're adding 5 more years to the amount of time it'll take to repay the loan. But that's not a huge change. I mean, those borrowers are still paying off principal. They're just doing it more slowly. So I think when Bank of Montreal looks at their portfolio and says, we're concerned because they were one of the banks that had these fixed payment variable rate mortgages, we don't want to see our mortgage portfolio not being paid off at the pace we're used to seeing. So we're going to trim our sales, but that makes them less likely to offer flexibility at renewal and more likely to kind of enforce the rules as they stand. And insofar as that trend continues, I would suggest that's going to be harder for borrowers, but the regulators like it more because making sure people are paying off their mortgages more rapidly is better for the stability of the financial system, assuming they can make the payments.
Right. So in so many ways, the COVID party is wrapping up in several ways. Maybe we're starting to see the pressure with small businesses, medium businesses. And as you were saying, even if Canadians keep up with their mortgage payments, that squeeze on discretionary spending makes it likely that we'll have a slowdown. So given that context, I think you and John have both said that I'm going to a question here. If BOC cuts rates, you first said that June is most likely now, will it overheat the spring housing market? Given everything that we just talked about, I think you're both saying no.
Yeah.
Hard to say. Go ahead, John.
Yeah, I mean, it's hard to say. I agree with David. I mean, my kind of argument up until now has been no, because like I said, even though rates hit the 4s last year in the spring and the market rallied, it was rallied because we were in an environment where new listings were at 20-year lows, or in some cases like historic, like 25-year lows. And I think that's going to be a very big difference this year. Even if the market rallies a little bit, I suspect we're going to see more listings, which should keep things more balanced, is what I'm expecting. But again, these are all just best guesses.
Yeah, and Urmi, by the way, if the Bank of Canada waits till June, it misses the spring market, right? Because the spring market usually by June, if it cuts rates in June, then it's going to affect stuff in July, and typically July is a slow month. So in reality, I don't think that. Look, there's no question. The Bank of Canada has to be worried that if it cuts rates and the housing market catches fire, then all bets are off, and we're going to get a big resurgence in inflation, because when people buy houses, there's all kinds of other demand created, right? You got to buy furniture, you got to. There's a lot of extra money spent. So that is that clearly their biggest concern is they don't want to reignite the housing market. But we're in the hangover phase, Urmi. I mean, when we talk about COVID, if COVID was a party and we spiked the punch bowl, we're in the hangover phase now. All of that demand that we brought forward to save the economy, well, we brought it forward from now. So there's less demand naturally. I mean, who needs a Peloton at this point? Everybody who wanted one already bought one. So a lot of that demand that was brought forward, we're now in the stage where that demand would otherwise have existed. And interest rates are going higher, things are getting more expensive, and a lot of those chickens are coming home to roost. So definitely, this is an economic hangover phase.
Yeah, and interestingly enough, I have a Peloton, and it's harder to drag myself onto it. So yes, that is very well said. Maybe I'll just end on a last question, going back to a bit of the theoretical question that you're raising, Dave and John. I'd be interested in your views. Dave, you mentioned that many countries that we compare ourselves to do not include mortgage interest costs in the consumer price index the way we do. And one question was, what's the percentage of shelter costs in the basket prior to COVID? I just want to piggyback on that viewer question by saying, funnily enough, when our interest rates were lower and our home prices were booming, we would think that as housing cost pressures, like all of us as Canadians would feel that if you were in the market. And then rates have a connection that's different. Rent rates have a connection that's different. But ironically, even though house prices were booming at a point, would the CPI index before COVID, when interest rates were low, show that housing costs were as big as a part of the that basket of goods that we had to afford?
Great question. The answer is no. When interest rates were falling, that was having a much bigger effect on the shelter cost component than the fact that house prices were rising, because house prices themselves aren't captured. So yes, I guess it would be a fair point to make, Urmi, to say you had your cake on the way down because lower interest rates made inflation look less threatening than it was. And this is the flip side of that coin. And now you got to eat the cake because rates are going higher. And even though that's causing inflation to appear higher and delaying the amount of time it takes for the Bank of Canada to start cutting rates, that's the other side of that bet. Basically, we won on the way down and we're paying on the way up now.
So John, just to finish off, when we look at all these different countries, why doesn't Canada reflect what it actually feels like as a renter or a homeowner with a mortgage in terms of what our housing costs feel like to us in that basket of goods? You know, it feels like they're measuring an inflation that's apart from that, or sometimes counter, even working anti-cyclically to that. And it makes us feel like the CPI index is disconnected from one of the biggest stresses on our household pocketbooks.
Yeah, no, for sure. There's definitely an argument for that. I think it reflects rents relatively accurately because that is, it's just looking at rental data. The challenge is, how do you measure inflation for owner-occupied housing? And I think this is something we need to wrap our heads around, because a home is, of course, shelter, and there's a shelter component that we need to think about. What are the costs to pay for this shelter? But of course, it's also an investment, and CPI's job is not to measure the returns on our investments, right? It's meant to measure kind of the returns on our shelter costs. And there's generally there's a few different methodologies. The two common ones that we talked about, the US basically says, you know what, we're not even gonna think about it as an asset. We're gonna say, well, what would it cost if you own the home? What would it cost you to rent it if you had to rent your own home? And that's what David was talking about, like owners' rental equivalents, right? So they basically try to estimate what the rent would be if you had to rent your own house, right? And that's why they don't factor in interest rates in their models, whereas Canada uses something called a user cost method, which basically says, well, let's add up all the costs to owning, which includes utilities and interest rates and property taxes and all of these things. And how does that weigh into a household's finances? So prices are kind of indirectly impacting it because, of course, our mortgage payments are a function of sort of what we pay and how much debt we have, and the interest rate. But yes, it kind of gives the opposite signal. During the boom when prices were skyrocketing and everyone expects homeowners sort of costs, shelter costs to be skyrocketing, but actually plummeting because like David said, because interest rates are plummeting. And now we've had, prices decline, interest rates up, and inflation is surging. So, there's some question whether Canada uses the best approach. I mean, it's the one that we have, and yeah, it is a bit problematic because it does give these weird signals where it's kind of doing the opposite of what you think it should be signaling.
Right. But I'm sure there's
I don't-
also cons to the US approach as well.
Yeah, 100%. Yeah, and there's been a lot of papers written about the pros and cons. There's other approaches kind of as well, but yeah, those are the kind of main ones. And I don't know if David had anything to add to that.
Well, I was just going to say, Urmi, be careful what you wish for, because if we include house price appreciation in our inflation data, then inflation is going to be a heck of a lot higher than 2%, and interest rates are going to have to be a multiple of where they are now if house prices appreciate at the rate they have for the past 10 or 15 years. So we should be careful what we wish for.
Yes, I certainly wouldn't wish for that. But I do understand why just the average citizen is always kind of confused by that metric. But of course, it's not straightforward. That's why there's so many different models, because there are so many Canadians that don't hold those mortgages, right? So I can understand why, including the sensitivity to rates is part of our calculus. So I can see why it's kind of tricky, right? If you don't include that, there are a lot of Canadians, correct me if I'm wrong, Dave, that don't have mortgages. So they're exempt from that pressure. It's hard to calculate how that recent surge in prices is impacting all Canadians in a strange way, right?
Yeah, exactly.
Right.
I think the one thing I hope, Urmi, is that the next time the media is sitting in the press conference of the Bank of Canada, somebody asks the question, why does the Bank of Canada include mortgage interest costs in its measures of inflation when most of the other countries don't? I think that's a question, at least I'd love to hear their answer, because they're doing something very different than other folks are doing. Everybody can tweak as they go, but they're counting that very differently. Others have looked at it and said, we shouldn't be counting it. It's not an appropriate measure of true inflation, and it'll distort the data. The Bank is saying, no, we should. I hope someone in the room, some media member in the room, asks that question next time. And I put that in my post because I don't know, maybe I get lucky. Somebody reads the post and they ask the question. Love to hear the answer.
Well, I snipped it out. So if I ever get the chance, I'll ask it. At the very least, if they don't want to move away from a very well-considered model, because I'm sure that would take a lot of doing, why they don't include a temporary measure or maybe a going forward measure to give that same number with that stripped out. It would seem very, something reasonable. So yes, if I ever get the chance, Dave, I'll be on it.
Nice. All right. I think we're near the end. We got a couple of questions, but we didn't have time to answer them. So, but thank you all for joining today, for posting your questions, for listening to the chat. Of course, you can always, if you jump in a little bit late, you'll be able to watch the live stream after the fact on our channel at YouTube. And of course, on our podcast as well. And Urmi, did you have something else to add before we wrap up?
I just want to say Ankush came in with some fabulous questions at the end, asking about increasing down payments on second, third, fourth houses, tapping into people using HELOCs. I just want to say stay tuned to Move Smartly, because those are massive issues, and we are going to be taking some of those on in depth in some of our other shows.
Awesome. Thank you, Dave. Thank you, Urmi, and thank you everyone for joining us. We'll see you all next month.